What's going on, guys? Welcome back to another Market in Focus. We are wrapping up the week here. Today is July 21st, 2023. My name is Hamilton. I'm here with the Trading Initiative. We generally put these reports out once per week for the members, but we're going to start putting these out for the newsletter. So if you like this type of content, please let me know. Reply to this email. Let me know what you'd like to see in the future. We're going to go ahead and start with this intermarket analysis as we do all the time. We're going to see what's moved this week and what hasn't, right? We're constantly building this thesis out, and we want to be on the forefront of any sorts of trend changes, and there have been. So inside of TTI, we've talked about this idea that there's a potential sector rotation coming in. It's been playing out for the last 4 to 6 weeks, but this week we finally got the go to go and buy some of these names, which we're going to go through in a second. So on the week here, IWM. We're going to go through the chart itself in a second, but this is a big one here. We're watching the small cap space breakout on a quarter-over-quarter basis. That opens up a lot of new potential in terms of the market, what types of names that we're trading. You might have already been trading some small and mid-cap names this week because they've broken out, and the ETF itself is confirming that. But I want to continue to dive in here and show that there's a change of tone here in the market. Small caps breaking out on the week. We have commodities starting to pop back up. We have value popping up. We have the crude oil price popping back up. This is a change of sentiment. The last 12 weeks has been dominated by growth. As you see down here on the week, the Qs are down. Copper is down. Bitcoin is down. The risk on areas of the market in terms of growth are down this week, and that is definitely a change of sentiment. So coming into this week, we've had this idea that potentially we're staring at the face of a sector rotation starting to play out. There's some internal information going around that we really like in terms of backing up this thesis, and we're starting to see it play out on a week-over-week basis now with the indexes drawing down. If you're trading Apple, Microsoft, Amazon, etc., you've seen some of the pullbacks this week, and it's being confirmed on a macro basis. So going into next week, go ahead and look for those value areas, right? Those industrials, energies, financials, healthcares to continue their breakouts. We're going to go through those in a second, but week over week, we are starting to see that rotation play itself out. Let's go ahead and look at U.S. sectors and industries really quick, and let's see if that actually makes any sense. Are the sectors rotating? Well, week over week, we have regional banks up 8%. Regional banks started to report this week. It started with last Friday, JP Morgan. That was a trade that we took as a group inside of TTI. They reported they beat, they're up big. We also took a trade in Zion, Z-I-O-N, and Comerica, C-M-A. Both of those regional banks beat. This ETF itself is up 8% on the week, but look at the other groupings around it. Oil and gas, exploration and production, insurance, healthcare, energy, financials, agribusiness. None of this stuff is tech. None of this stuff is consumer discretionary. None of this stuff is communications. This is a change of sentiment this week. If we actually go down and we look at some of the previous market leaders through this entire year, semiconductors are down 1.78%. The discretionary and communication ETFs are down over 2%, etc. We are starting to see that sector rotation play out, and it's important to understand as a technical trader, your number one job is to identify trends as early as possible and take a position. So let's look through this really quick. We're going to look at the 3-month information here because year to date is just going to show monster returns for growth, communications, and consumer discretionary, and rightfully so. We've been long most of those names all year, and they've been very fruitful, but we believe that there's some short-term weakness coming in, at least in terms of where the max potential reward is, and that's the value areas. If we look at this 3-month chart, we can see XLI popping up. Nice steady uptrend starting in the end of May here, and we're starting to go long some industrial-related names. It's going to soon take out this SPY metric on the 3-month, and then what happens? You're going to start seeing a lot of people talk about the industrial related names, as we're going to see in a second. By the way, on TradingView, industrials are at an all-time high right now. Financials kick-started last week due to the JP Morgan earnings. They are starting to outperform on the 3-month. Real estate, we're staying away from. Materials, we're staying away from right now. But look at healthcare. Healthcare started to report last week as well. United Health, they beat, and this sector is up huge and potentially pressing into all-time highs. Energy, kind of the black sheep, but we'll get into that in a second. Also starting to print higher highs. So we're starting to see tech peel off a little bit and value pop up a little bit. We are taking note of that and building thesis around that. We can look at industries as well. We see semiconductors are down over the last few days. Software, Not necessarily showing a whole lot of weakness, but also not popping up on the same sort of vigor that it has been. You see some of these names that have been leading the market are just kind of cooling off. And I think that's the name of the game here. The sector rotation does not necessarily mean that growth names are going to sell off and you should buy puts or go short Apple, Microsoft, Amazon. No, no, no. What the market is more than likely going to do, at least within our opinion, it's important, it's our opinion, is that they're going to start buying the underbought areas of the market more so than the overbought areas of the market. And right now, the overbought areas of the market are those tech, consumer discretionary, and communication names. So once again, we are looking at a potential sector rotation playing out right now. Let's actually look at this on from TradingView, right? Let's go ahead and start with the obvious, right? Let's look at some of the three major growth areas from a sector ETF standpoint. You have your consumer discretionary. So this got hit hard yesterday based off of Tesla's earnings, whatever. What I want to focus on here, though, is even though we're in a clear uptrend, we are starting to show a bearish divergence here. We see that the RSI is hitting a lower high as price is hitting a higher high. That is a bearish divergence. That's not to say consumer discretionary is going to capitulate back down to something crazy like the 200-day moving average. It just shows that the momentum is slowing in price action. That's it. Therefore, we want to be looking at areas of the market that are not slowing in price action. We want to continue to buy the areas of the market that are showing great momentum. Tech, same thing. Tech's at an all-time high 2 or 3 sessions ago, but we are starting to see slowing down in the momentum of the underlying trend. RSI, higher highs, lower highs, and price here, higher highs. That is a bearish divergence. And we'll finish off with the last one here, communications, higher highs in price, lower highs with the RSI. Once again, we're not saying we should go and buy puts or short these areas of the market. We just want to reallocate our scarce capital towards some of the areas of the market that are not losing that momentum. All right, so let's go ahead and start with the chart of the week. It's the Dow Jones Industrial. If you're following me on Twitter, you know that we've been talking about this for a long time. And inside of TTI, we have watched this price consolidate underneath the 34,500 area all year, going back to November of last year. All of that compression underneath that level has finally resolved to the upside with an incredibly powerful breakout. The Dow, as of right now, is less than, if I'm not mistaken, let's see here, less than 5% away from all-time highs. Less than 5% away from all-time highs for the Dow. That is incredible. So let's go ahead and actually go back and look at really quick the Dow Jones holdings. If you don't know too much about the Dow Jones, a lot of the old school traders and investment managers view the Dow Jones as a more true reflection of the total market. And the reason why here is if we look at the weightings within sectors, even SPY is predominantly tech. It's not as bad as the Qs, obviously, but it's still predominantly tech. If you go to the Dow Jones, you see financials are the leading sector within the Dow Jones, followed by healthcare, and then tech, and then industrial. So it's a truer reflection of the broader market, not just tech, and that matters. Why? Because if we're expecting some sort of sector rotation and we're seeing the Dow Jones break out finally after almost an entire year underneath that 34,500 area, we expect the sectors that make up the Dow Jones, at least the brunt of them, are also going to be breaking out. And they are, which we're going to look at in a second. So the Dow Jones was really the focus point of TTI's thesis here this week, and we've started to buy some of these names as the Dow Jones breaks out. The other chart that I really want to stress here is the small cap IWM, your Russell 2000 ETF. We believe that if we break and hold above this 195 area, and take out the previous highs here in February of 2023, this will be a series of lower lows, or higher lows rather, and a series of higher highs. This is the beginning of an uptrend. Why does this matter? This matters because IWM, a large majority of it, energy and financial names. And those are the areas of the market that are starting to pop up, right? So an accommodative small cap space gives us a vector of attack by allowing us to trade higher beta names within the financial and energy sector. Because to be quite frank, a lot of the banks and a lot of the energy names take forever to trade. They're not that fun. They're fruitful, but they're not that fun. They take a while. You got to buy a lot of time and adjust your expectations. An accommodative small cap space gives us the opportunity to go out and buy some higher beta names. And that's what we want. So let's look really quick at the sectors that we're looking to buy here. XLE. We are stuck within this range all year, but we are seeing some aggressive moves in the industries that make up XLE. You have to understand that XLE is comprised of some mega giant companies, mega caps, right? You have XOM, Exxon, Chevron, CVX, stuff like that. They take forever to get moving, and therefore XLE is going to take forever to get moving. But let's look at some of the higher beta names, industries within energy. You have OIH that is breaking out into a potential 4-year high. Your oil services ETF, which is a tranche within that energy sector, is already starting to break out. And then your XOP as well is showing a little bit of life here, which is another high beta area of energy. We expect both of these to lead, right? We expect both of these to lead in terms of the energy break. And we think that above the 200-day moving average, we have the first little green light to open up some energy related plays. We did nibble our toes into energy stocks this week. We have one open position as a group. We expect above that 200-day moving average will give us another opportunity to find yet another position or add into the one that we have. This is a potential area of the market that is going to outperform in the second half of 2023. We just don't know if this is the perfect spot to be buying, but something that you should be actively looking at. Healthcare, spurred on by the United Health and the Johnson & Johnson earnings, is up huge. I don't need to point this out, but healthcare is about 5% away from all-time highs as well. The entire bear market, healthcare did not really sell off. It just went sideways in this massive distribution cycle turned accumulation cycle. Does this end up being the opportunity for healthcare to really break out into all-time highs? We think there is an opportunity here. Yeah, we're starting to see a lot of the big mega cap healthcare names, United Healthcare, like I already said, etc., and some of the mid and small cap higher beta names break out. This is a space that we want to start accumulating positions, because when or if healthcare breaks out to all-time highs, everybody is going to be trying to buy these, and we want to be there before them, right? Remember the Dow Jones sector weightings. Healthcare is a big component of that, and the Dow Jones is breaking out. Therefore, we expect that the trend is going to continue to the upside for the constituents as well. Industrials are already at an all-time high. So we've been long industrials for about 2 or 3 weeks now off of this breakout. It shouldn't surprise you that a lot of this looks similar to other ETFs, Dow Jones, etc., or the indexes rather, because if you think about it, indexes are comprised of companies. And these specific sector ETFs are also comprised of those same companies. So you're going to see a lot of the same price action. There's confluence between them, right? So the industrials here, all-time high breakout. We took positions in industrials a few weeks ago. We're starting to see a continued breakout. Where is the difference in the divergence that we were talking about within XLK, XLY, and XLC? There is none yet. We're hitting higher highs in the XLI ETF. We're hitting higher highs in the RSI. That's what I'm talking about in terms of waning momentum in the growth space. There's no waning momentum in industrials yet. We're at all-time highs, and we continue to press into all-time highs. Therefore, maybe it would be in your best interest to look for stocks within that XLI space, and I'll go over at least one at the end of this conversation here. The last sector that we're looking at, and we actually have exposure for, is this financial space. It's not the prettiest looking ETF, but we said, listen, if there's ever a time for financials to break out, it's with the Dow Jones looking to break out. We're back up and over the 200-day moving average. We've completely erased the regional banking drawdown from March. We see names like JP Morgan are leading the financial space. That's why we grabbed this particular play about 2 weeks ago, week and a half ago. The entire write-up is on my Twitter. If you're not following me on Twitter, I'll show you that at the end. But this is the type of stuff that we're looking to go long right now, because there's a real opportunity for JP Morgan to hit all-time highs up near 170. We also took Zion as a group. You can see that's a little breakout as well. This is a smaller regional bank name, but a little nice little inverse head and shoulders here that we bought the breakout of prior to ER, and then we got the big gap up on ER. This is a very fruitful trade. We are expecting financials to really start pulling their weight second half of 2023, and growth start to actually pull back here. So the last chart I'm going to leave you on, kind of the trade, if you will, of the week here. This is not going to be a grand slam trade. This is going to be a bastion for our next tranche of positions here, specifically in this sector rotation idea. It's Caterpillar. So if we're looking at different areas of the market to be buying, we like industrials at all-time highs. We have one of the world's largest machinery companies at all-time highs as well. This is a notoriously slow mover, and we did try to get up near all-time highs back in January of 2023. So it's important to understand that this is a very volatile level here. We don't want to own this thing with too much size unless we're clearly above the 260 area. We want to own it above 260, sell it below 240 with a price target up here near 320. This is a longer dated play because it's a slow mover at 2.4%. 2.04%, and we're expecting potentially a 20 to 25% move. You're going to want to buy a lot of time on this play because it's an all-time high breakout. There's going to be no resistance to the upside once it does clear and start trending above that 260 area. The RSI, no divergence, bullish momentum regime with a catalyst coming up. They are reporting on the 1st of August. We think that this is just a nice, cornerstone trade to get positioning in on that industrial sector and this entire sector rotation idea. And so that's how we're going to play it. All right, guys. As always, I appreciate you. If you're not following me already, please follow me on Twitter. You can DM me. You can message me. You can see everything that we're doing live. We post all this stuff all day. It's the best way to get a hold of me. I appreciate you. Follow me on Twitter. If you have any questions or you like the content, please let me know. Email me back, and I will catch you in the next video.